Move on to another guest here. Gautam Duggad, Managing Director, Head of Sales, Institutional Equities, joins us uh, today from Motilal Oswal. Gautam, hi, morning. You know, you've seen how the flows happening at this point in time. FIs have sold nearly $30 billion odd in this calendar year alone. How are you looking at institutional flows?
Hi, good morning. Thanks for having me. Yes, we are in a bit of a headwinded environment as far as flows are concerned. Last entire year, you look at the data for calendar 25, FI selling was $20 billion odd, or 19 maybe. And this year, as you rightly said, already the 6 months are not over. Half of the year is not yet closed. And we've seen 50% higher selling than the full year selling of last year. So clearly, we are in a bit of a headwinded environment as flows are concerned. Not that from a long-term perspective, flows alone decide the direction of the markets, but clearly in the short term, it does have a disproportionate influence. I think this situation can continue in the short term till we see clarity on the geopolitical front, where the war has been there for last 3 months now. At the same time, the commodity prices stay elevated, currency has been under pressure, and of course, our headline growth for the benchmark indices, insofar as earnings is concerned, needs to pick up. While the broader market earnings have done fine, the headline indices are still struggling. So 2 years Nifty earnings have been flat, and we have seen how the markets have behaved. Prior to FY24, the 4 year earnings compounding was 20%, and markets rewarded that with the equivalent sort of compounding. So clearly, earnings need to grow first before other factors come into picture. Of course, at the margin, flows being so uh, intensely negative is not helping the cause. But very difficult to pinpoint when the flows will turn, and that's not, of course, my expertise either. We all see on a day-to-day basis what is happening, but beyond that, very difficult to quantificate as to when the flows will reverse or when the selling will stop. Our growth first needs to improve, and that will be one important criteria, because regionally we are competing with markets where the growth has been very solid, especially in the last 2 years, while we've struggled on the growth. So that equation needs to change first before flows reverse.
Gautam, if you look at India's weightage in various global indices, including the MSCI Emerging Market Index, it has fallen to nearly 11 odd percent from 20 odd percent in mid 2024. In the absence of uh, a push or momentum coming in favor of India, how do you see this underweight position now at least moving to a neutral or a overweight position?
Again, very difficult to say, because these are all consequences of the underperformance. These are all factors which work. They're all force multipliers. If, say, for example, India's growth changes, flows return, markets do well. Markets doing well will essentially result in higher weight for India. So all of them are interlinked, right? When we were doing well on growth, when we were doing well on markets, automatically India's went up. And now the fact that we want to perform for 2 years, clearly the momentum has changed since September 24. And we are bearing the brunt of that insofar as our weights in MSCI is concerned. Again, at 25 or whatever number you said, we didn't forecast that it will go to 11. Similarly, to pretend that 11% we know where it will change will be equally difficult. So let's see how this situation pans out. Like I said, the antidote of everything is in growth. If we see growth making a comeback, a lot of these factors will follow through. The outperformance, the weightage in various indices, the flows, because globally the capital is chasing growth, and that's where we are right now underrepresented, which is where markets like Korea, Taiwan, and some of the other regional markets have benefited, because globally the AI trade has been very strong. So whenever you see some moderation in that trade, either the growth slips there or people get fatigued with that trade, you will see India as a natural beneficiary of that fatigue. But timing wise, very difficult to pinpoint.
Gautam, taking a bit of a step back, I believe congratulations are in order, a change in designation, a change in role as well. So many congratulations from all of us here at ET Now.
Thank you.
All right.
Thank you.
Right. And Gautam, with regard to the trend which Motilal Oswal put up in its most recent strategy note, that corporate profits as a percentage of GDP are at all-time highs. Two things that I wanted to ask you on this. One, is this a sustainable trend? Does this continue going upwards? And two, what's causing this? Is it just purely more registrations that are coming through in terms of the formalization of the economy?
Yeah, very good question. Look, corporate profit to GDP, once it bottomed out in 2020 at 2%, of course, that was the very different era. Since then, we've been steadily trending upwards. We went to 4% in FY23. Then we almost reached 5% last year in 25. And right now we are at 5.2% as far as Nifty 500 is concerned. If you take the entire universe, we are at 5.7. This is almost like an all-time high number. There are two or three factors which are responsible. One, see, this is a ratio. So clearly the nominal GDP has been a bit underwhelming in the last 2 years because the inflation has been under control. So that has also played a bit of a part. Whereas the profit cycle which turned around in 2020, I mean, if you look at just the Nifty 500 profits, just to take a sense of absolute numbers, we have seen almost 29% CAGR since 2020 to 2026. We were at 4 lakh crores of profit in Nifty 500 in 2020. We ended the year FY26 with 18 lakh crores of profit. So profits have gone up by 4.5 times. What has happened to the GDP? Nominal GDP in the same period has compounded at just about 9.5%, from 201 trillion to somewhere about 346 trillion. So that's less than 10% CAGR. So clearly the ratio has improved a bit. As far as the next 2 or 3 years are concerned, in fact, this calendar year or this fiscal year FY26, my broader coverage of 370 stocks have delivered 15% earnings growth, which is same for Nifty 500 too. But Nifty 50 was just 5% up in terms of earnings and EPS. Going forward, we are expecting next year the earnings to grow at about 12-13% for our broader coverage and Nifty to have about 15-16% earnings growth. Our expectations of nominal GDP for next 2 years are somewhere in the range of 10 to 11%. So if you just do the simple arithmetic, the the corporate profit to GDP still has some legs to improve so far as ratio is concerned. Now, which sectors have contributed, which sectors are not? In fact, if I look back, the top 5 sectors which have contributed 3/4 of the improvement in the ratio were BFSI, oil and gas, automobiles, metals, and of course technology because of the size. So if you add up these 5 sectors, they are almost 76% of the total corporate profit to GDP ratio. So clearly we see legs for this ratio to improve further as we expect earnings to recover a little bit for Nifty too, and our broader coverage to maintain the current trend of about 14-15% earnings. So do remember this year, despite Nifty growing 5%, the Nifty 500 and our broader coverage of 370 stocks have delivered 15% earnings growth. So that's a big number. What is also getting hidden in the overall aggregates is the fact that mid-caps have continued to outperform on earnings versus large cap by a mile. If you look at this particular quarter, we have seen 36% earnings growth in the 101 companies that we track in mid-caps. Expectation was 25%. Large cap grew 12%, mid-cap 36% for the quarter. And on a full year basis also, large cap earnings grew 10% or 11%, whereas the mid-cap earnings were up 32%. And that trend we expect to continue. Next year also, we are expecting mid-caps to do about 16%, while large caps to do sub 10%. So there are different nuances which are playing out in that one ratio. But to answer your specific question, we expect the ratio to improve over the next 2 years as well.
Gautam, that was going to be my next question, in fact, that FY26 has a depressed base, especially on the Nifty 50 because of the growth that it clocked. But you kind of elaborated on that beautifully. Give me a sense, therefore, where do we sit with regard to risk reward? Obviously, mid-caps trade at a premium, have always done so. But how much of that premium is justified is what I'm trying to get to versus the large cap index.
Look, I would think that in India, growth always gets a disproportionate premium. India is a growth market. I'm not disregarding value because ultimately, even in value investing, the value is realized when growth follows, right? India has always been a growth market. Even in segments that you do, there are five broad cohorts of market: financials, consumption, technology, industrials, and healthcare. At every segment, you will see wide dispersion in valuations. In same sector, if a company is growing at 10-12%, the kind of multiples that it is enjoying is very different than the company which is growing in 20-25%. I mean, if I were a little casual, I would say there is no cap for P's for companies which are growing upwards of 25%, and there is no floor for companies which are not able to print even 10% growth. We have seen sector after sector derating, FMCG, staples, some of the private banks which have not grown for last 2 years. IT is a clear-cut example. For 5 years, the earnings growth has been sub 10%. And of course, there are headwinds on the disruption of AI and all of that. But to answer your question, mid caps, as long as they continue to grow at this pace, there is no debate that valuation will remain expensive. Second technical factor, which is also helping mid caps, is large part of the FII selling has been concentrated in the top 100 stocks, because that is where their broad holding of about $850-900 billion is heavily concentrated. So till the time FII selling continues, you will be right in expecting that the large cap valuations will continue to look far more attractive compared to mid cap. But that discount of large cap right now, while it is attractive, it can continue till the time we see growth picking up even in large caps. In segment after segment, at the cost of repetition, I must add that large caps within Nifty 50 are struggling to grow. I mean, if you do a bottom-up analysis of Nifty 50, there are about 20-25 companies where the growth is sub 10% in the range of 5 to 7%. And market, in my view, is right in sort of not ascribing any premium to that kind of a growth.
Gautam, you spoke about value in mid cap and small caps, and also the foreign flows, foreign outflows, which is coming. In your opinion, how much more outflow can happen, given that you said a lot of outflows is from the top 100 companies?
Again, difficult to answer because most of your questions are around the exact quantum of selling that can happen. I wish I knew the answer to that, right? Because 1 year back, we didn't know that between CY25 and first half of CY26, we will see $50 billion of outflows. So again, to pretend today that we know the answer as to what the quantum of outflow will be for next 6 months will be a bit foolhardy. So I won't hazard a guess there. All I would say is that till the time you see sentiments around India changing, growth picking up, macros improving a little bit, crude oil prices cooling off, the situation on the war and geopolitical front improving, I think we will remain in a headwinded environment as far as the FII flows are concerned. Beyond that, to quantify it, the timing, duration, very difficult.
Gautam, just from a 5-year standpoint, if you were to point out one of the largest risks that we could see from an Indian market standpoint, what could that be? Something which is not really built in by the market currently. What could India's downside surprise be in terms of a risk?
So look, we've benefited a lot in the last 10 years because of two things. One, our growth picked up post-COVID. And second, the overall sentiment around equity insofar as the average investor is concerned on the street has been very, very positive. I was just looking at the data. While a lot of things get highlighted on the outflows on FII side, if you look at CY22 onwards, 4.5 years almost, total quantum of flows that came in from the domestic savers in equity is almost $250 billion. Of course, foreigners have sold close to $45 billion in the same period. But the equity as a cult in India, which has grown over the last 10-12 years, even the data which has come out for the month of May for mutual fund inflows, is pretty solid, I would say. There's a consistent SIP book which has been growing over the last 10 years. That could be one risk if there is continued low returns from equities, low to moderate. Because now on a 3-year trailing basis, the portfolio returns are very, very abysmal. Whether it is a lump sum return or a SIP return. So that is one risk which we are not discussing today that can manifest. I'm not saying it will happen, but since you give me a time horizon of 5 years, I'm just thinking loud. Second, of course, if our growth doesn't pick up, because as I said, and at the cost of repetition, India is a growth market. People come to India for growth. So if we don't manage to grow beyond 15% on corporate earnings, there will definitely be a risk on valuations. Because last 10 years or last 15 years, we've benefited from combination of QEs globally, which has made the money cheaper, which is now changing. Obviously, you're seeing inflation being high everywhere. Second, the earnings which has picked up for last 5-6 years, and third, the whole domestic equity cult which has begun post 2015. So those three factors have helped us in so far as equity markets are concerned. Therefore, the risk on growth and risk on the domestic equity sentiment turning around can be pretty big in the next 5 years.
All right, Gautam, thank you so much for coming in and speaking to us. And congratulations once again on the new role that you've taken up.
Thank you. Thank you so much.
All right, what we'll do is, viewers, slip into a very short break, come back with more. Stay with us here on ET Now.